Hi there, just read this disclaimer please. Okay, so it's my my daily check for news. I forgot to mention, once I've clicked in something it kind of greys out because the cookies tell my browser that I've been there before, so it's quite easy to click through quite quickly and see if there's a new one, because it's there. So there's a new one there for Lowland. I just wanted to have a little read through it. The annual report. I'll never use it as... What I read here is probably not going to affect my decision to keep holding it or to buy more or anything. Just more reading it out of interest really, just to see what's going on. Probably won't even read it all. I'll probably just scan the document really. So Lowland is the kind of the multi-cap investment trust I told you about before. It's been raising its dividend a lot in recent years, so lots of income growth, but not very good on the capital side of things. It's been flat, well, up and down, but flat over the past few years, whilst the market has done better than that. So if you look at the 10-year chart, we're below levels from 2013 probably. We go to the FTSE 250 because there's a lot of smaller companies or mid-cap companies in Lowland, but it's a multi-cap thing, so it's actually probably the FTSE 250 and the FTSE 100 as well together are probably closer to it. I don't really care what Lowland itself declares as its benchmark, because it doesn't mean anything to me. We look at the FTSE 250, but as you can see, I talked about going flat from 2013, or actually down from 2013, but look at what happened from 2009 compared to the two indices here. These graphs don't include the dividends, by the way, so probably compared to the FTSE 100 it's probably got a lower yield over this 10-year period, and it's probably a similar yield to the FTSE 250, so that's probably a fair comparison, roughly. I don't know where I get the full data, but obviously, so over 10 years it's done about the same as the FTSE 250 and handily beaten the FTSE 100 probably, even if you add the dividends, the extra dividends that the FTSE 100 has probably had. The dividend hasn't grown half as much as the, Lowland's dividend, but it would have started off much higher. So it's beaten that over 10 years, but then if you go for 5 years it's pretty bad really. Well, you know, not the end of the world. So if gritting your teeth through 5 years of underperformance like that, which is a bad performance but not the end of the world, if that's the price you have to pay to get a 5-year period like this, from 2009 to 2000, where is that, 13 or something, from there to there, if I hold it for 5 years and it's flat, and then it goes through another period like this, then you know it's been well worth holding. But you know, it's all just hopes and pipe dreams, isn't it? Anyway, let's see what they've got to say. That's a bit weird that the ongoing charge has been higher this year than it was the year before. Because if anything, the charges are going down. So that must be transaction cost rather than the actual charge. So I think the ongoing charge is the fee for doing the management that we pay Henderson, Janus Henderson now, which is the fund management company or whatever they're called, and then it adds on to it the transaction costs, like the costs of trading and things like that. So as you see, that's how much Janus Henderson gets paid, but the ongoing charge is a bit higher. So yeah, that must be higher because of higher transactional costs compared to the year before, because I know for sure that this number, the annual management charge, has not gone up for sure. the whole industry is reducing charges. Dividend yield, that's the other thing you see. This reflects, I think earlier on, like in this time period here, the yield would not have been higher than 3% or something. Historically, this was kind of a lower yielding, growthy kind of investment trust. But now, as you can see, because the share price has been flat or down a bit over these years, these 6 years, that's down, and it's had phenomenal growth in the dividend. So that's why the dividend yield is actually almost as high as the FTSE 100, I think, which is very unusual for this trust. In terms of capital, this was a disappointing year for the trust. Not only did net asset value underperform the FTSE All Share Index, which rose 2.7%, but it declined in absolute terms by 9.6%. The reasons for the underperformance are set out clearly in the fund manager's report. Firstly, Lowland runs a multi-cap portfolio. It's relatively high weighting in small and medium companies, which has served it well over the long term. Has not done so recently, with companies being more exposed to the uncertainties of the UK. It has a sectorial bias towards industrials, which isn't doing well right now. I'm not reading it verbatim here. Finally, the focus on investment shares, perceived to be undervalued as opposed to the growth stock, has been out of favour. Yeah, same old story. Value investing is out of favour. Will it ever become back into favour? I hope it is, because I think I've probably got more value than I have growth in my portfolio. So earnings grew. That's good. Earnings grew by 16%. See, I was concerned. I was thinking to myself, how can this run carry on for much longer? Because it's been going on for 7 years, of circa 10% increases in the dividend. But this seems to suggest that actually the underlying earnings has gone up by 16%, which is, when it says earnings, that's the dividends that the companies are paying Lowland. Oh, here we go. Right, so that's not the full story. 6.1 pence of the increase is the result of the decision to capitalise 50% of the management fees and finance costs. So that means that I think they used to take all of the fees, like the management fees and the costs of trading. They used to take it all from the dividends that they got paid. But now they're taking half of it from the dividends and half of it from capital, from selling some of the shares they own. So let's do the sums then, shall we? So 6.1 pence is because of the way they've changed the charging. So 9.4 pence earnings increase, and 6.1 pence of that was because of the change in the way they take the admin and management fees. That means they've only had a 3.3 pence increase. If we divide that by 68 pence minus 9.4, so that means last year's earnings must have been 58.6p, if I've got that correct. Let's have a look if I've got that correct. Earnings per share. Have I got that correct? Yes, 58.6p. Oh, it's almost like I actually know something. I didn't expect that to be right. So, actually, the underlying dividends have actually risen by 5.6% by my calculations. Okay, so that isn't too great. So, I don't expect this to carry on. And given that, that solidifies that thought actually. Maybe we'll go back down to increasing by about 5% or something. Let's see. So it's been well covered by earnings. 2.3 million has gone to the revenue reserve for the bad years. This is what I saw. It's noteworthy that our dividend yield of 4.6% based on this year's dividend has now risen to a level only seen on one previous occasion over the 29 years of James Henderson's involvement with the company. He's the co-manager, he was the original manager who's probably passing it on to Claire, to Laura Fole. There may be some comfort in the fact that on the previous occasion, the spike in yield was followed by significant outperformance in Lowland share price. Whether or not that history will be repeated, we conclude from the revenue position that there is real value in the portfolio. Well, let's hope so, but I wouldn't be surprised if growth style investing just continues forever, or for longer than we think. That's why I have some in both camps, but more in value because I want the income to live off. This is what I was talking about before. I think they have a maximum of 50% in FTSE 100 companies. At the moment they're at 44%, which seems high historically, due to the purchase that the fund managers just be good for the largest of which are RBS and Glaxo they've bought. So it's actually below 0.5%. Not much though, because I think the value of the trust isn't much higher than that, to be honest. So I think it's probably close to 0.5% that they charge us. 0.5% assets. I think it's a net asset value they do it by, isn't it? Net chargeable assets. I presume that's the same as net asset value. Market capitalisation. Yeah, 435 million is the assets. Yeah, so it's not. It's going to be pretty close to 0.5 because it's not that much higher than that number, is it? There we go. Increased 4.5% year on year. Not as good. It can't be as good because they've been increasing the dividend by 10% for the past few years. So the underlying dividends they receive must have been increasing by 10%. Otherwise, the dividend cover would have dropped off. But it hasn't. It hadn't until recently. Look, the dividend cover was still covered, increasing by 10%. So this is obviously, compared to recent years, that's a low increase in the dividends that they're getting paid, 4.5%. Pressure on smaller companies because of the open-ended fund issues. They're obviously alluding to Woodford there. So they're saying that cause pressure on the prices with some fund managers in effect becoming forced sellers. Some. They're talking about Woodford. So as I said before, they bought RBS. I already own some RBS as well. How good can these fund managers be if they're doing things that I personally have done, given how crap I am? Makes you wonder, doesn't it? Makes me wonder anyway. So they reduced Royal Dutch Shell because it got to 8% of the portfolio and they reduced it. Just see if those numbers stack up. I think these numbers are comparable because they had. I know for a fact Lowland hasn't issued any equity and it hasn't bought back any equity either. So these numbers are comparable. It should give us that 4.5% they said before. 19,757 divided by 19,757. 4.5%. Yes, it makes sense. Right, let's see if they're announcing any more dividends. What have we got anyway? Where are we on their dividends? So the last one, oops, that's not right. Third interim was paid on the 31st of October. So the next one due is the end of January. So let's see, it's probably a bit early for them to be announcing that, to be honest. But we'll see if it gets announced. I don't know what I'm looking at most of the time, to be honest. Oh, here we go. The final dividend, if approved, they always get approved, of 15p, right? So it's going to be 15p again. Will be paid on the 31st of January 2020. There we go, so I can fill out my information for LWI. 31st of January 20. Oops. And it's 15p again. A little dividend increase. So what does that make that year's increase then? Another 10%. Don't ask me why. This tab has a slightly different kind of year. I think this is more trying to do it by calendar year, whereas this tab is doing it by financial year of the trust. I've no idea why. It just organically happened that way. I can't remember the reasons. Right, there we go. There's my little scan through the annual report for Lowland. It's another one where I think to myself, am I just holding on for dear life through stubbornness and it's not going to pay off? Or will my stubbornness pay off in the end? Who knows? Who knows indeed. Alright guys, thanks for watching. See you next time.